Howdy, y'all. Welcome to the weekly wrap-up. It is Friday, August 19th, 2022. Hope everybody's having a fantastical week out there in the interwebs. You can see the back half of my dog over my shoulder. He is ready to go for the weekend and probably go play some ball outside. It is a nice day here in Colorado. It is a balmy 73 degrees, so feel bad for me. I think we're past the hottest part of the year, thank goodness. We had a bunch of 90-degree days, late last month and early this month, but it looks like that's behind us. Unfortunately, we got snow in our future. Probably in the next 4 to 6 weeks, there'll be snow on my front yard. So again, it doesn't get as hot here, but we have to deal with the white stuff half the year. So anyways, if it's your first time watching, I thank you for joining, and please give me a like, share, subscribe, all that good stuff. I would greatly appreciate it. Pretty ugly day in the market. This is what, 2 out of 3 days that we've had the indexes have been pretty significantly down. So, but again, like I've been saying, don't think the worst is behind us. With everything that's been going on and what the Fed's been doing and all the mistakes they've made along the way the last 2.5 years, I think we got some more slogging ahead in front of us. So anyways, well, let's go ahead and jump in and take a look and see how the indexes did today. The Dow Jones was down 0.86%, closed at 33,706. The S&P 500 was down 1.29%, closed at 4228. NASDAQ was down 2.01%, closed at 12,705. Small caps are also down over 2%. The VIX was up 5.32% today. It's currently hovering around 20.6. Checking out the other indices here in the Americas, Canada was down 0.76, Brazil down 2.04%, Mexico down 0.52. Top across the Atlantic, in Germany, they were down 1.12%. The UK up 0.11, France down 0.94, the Euro Stoxx was down 1.25, Netherlands was down 0.87, Spain down 1.09, Italy down 1.96, and let's see here, Switzerland down 0.1, and same with Portugal, also down 0.1%. Moving further east, the MOEX in Russia was basically flat, finished up 0.04%. And the RTSI was up 0.71. Headed over to the Asian markets, mostly red here too. Japan was basically flat at down 0.04. Australia up 0.02. That's huge. New Zealand down 1.32. In the Chinese markets, the Shanghai was down 0.59. The SESE component down 1.27. The China A50 down 0.25%. DJ Shanghai down 0.66. And the one bright spot in China, the Hang Seng was up 0.05%, and the Taiwan weighted came in up 0.08%. So not the best day in the markets. So if you've been kind of sitting there, if you're anything like me, you've been watching the charts, I'm like, well, should we increase our equity exposure? Should we wait? Just kind of looking at the charts going, well, it's kind of iffy right now. Kind of glad I held off because it looks like maybe we've this one has peaked for the time being. So, all right, well, let's take a look and see how the index is fared for the week. Starting off with the Dow Jones. Looks pretty flat. Looks like if it is up for the week, it's up 0.01%. So it's basically a straight line from Monday morning till Friday afternoon. The S&P 500 is going to finish in the red for the week, down about 0.94%. NASDAQ looks like it's down for the week, about 2.15%. The Dow Utilities, start at the bottom of the candlestick, up about 1.41%. And the Dow Transports is going to finish in the red for the week, about 2.18%. So it looks like the Dow Utilities was the one bright spot for the week. The Dow, like I said, looks like it's going to finish flat after having a nice Monday and Tuesday. The rest of the week has been, Thursday was an up day, but there was a lot of volatility. But for the last 3 days, we've been in a little bit of a slide. So, all right, well, let's take a look at what the trend looks like right now. This right here is the beginning of the year, January of 22, and you can see where we did bust through the line of resistance. What was that, about late July-ish time frame? And we did have a little bit of a trough here, and then it picked back up the last couple of weeks. So again, if you just were to look at that and say, oh, well, we broke the resistance line, everything is fine. I don't know. Let's look down here at some of these other charts. The relative strength indicator has started to drop again, and the money flow is also, looks like it's starting to fall. So again, it's kind of one of those iffy situations where, well, should we put more of our dry powder back to work, or should we wait for a lower entry point? So, as of right now, I'd say we probably are best holding off, waiting for a better entry point to get back in. Again, looking back historically, we can go back to 2008 and 9, and we can see where, again, we had a bunch of different situations where the market did have a nice rally. That first rally in December of 07 was up 6.5. This one was up 11 and change. This one was up 5.86, and then we had a bunch of choppiness going into 2009. So again, don't let just a couple of weeks of good behavior in the markets head fake you out, and because you certainly don't want to wind up in a situation where, oops, what did I do there? Don't want to wind up in a situation where, hey, we put all our money back in right here, and then back down, because from this high point right here where it was up 11%, it went on to fall another 50% from that point. So not the best anyways. All right, well, let's go ahead and close that. And we can go ahead and jump into the economic data that came out this week. Starting out, initial jobless claims came in at 250,000. The forecast was 265. So on the jobs market, that still looks pretty good. I have an article a little bit later talking about what big business is considering as far as layoffs and things. Last week's numbers were revised down from 262 to 252. Still better than, so revised down, which is a good thing. So let's go to the continuing jobless claims. They came in at 1.437 million. The forecast was 1.438 million. So about 1,000 under forecast, which is pretty good. Last week's numbers were revised up from 1.428 to 1.43. So nothing dramatic, just a couple thousand there too. Industrial production year over year came in at a 3.9%. Last month's number was a 4.02. And again, kind of just staying stable the last few months. So we'll see if, the next month's numbers start to fall. But, from a 4.02 to a 3.9 isn't exactly that dramatic. So, all right, U.S. housing starts. They fell quite a bit from the way it looks on the chart. We came in at 1.446 million. The forecast was 1.54 million. It's off by quite a bit. And again, you can see here on the chart, what month was this? This was May. Looks like the high point, and we've had several down months since then. So again, a lot of that has to do with the increase in interest rates. It's really just put a big anchor on the on the housing and lending business. Retail sales year over year came in at 10.02%. Last month's number was 8.54. So again, as far as retail sales, we can see here that going back to April, we've had a nice, flat to upward trend, which looks pretty good. I guess people are spending the money they've been saving up for the last couple seasons. U.S. existing home sales is currently sitting at 4.81 million. The forecast was 4.89 million. And again, going back to the beginning of the year, it looks like things had kind of rebounded from the previous year. But now with the interest rate impact, we've had just consecutive months where it has fallen let's see, the peak was 6.49 million, and today we're sitting at 4.8. So, all right. And the index of leading economic indicators came in at a negative 0.4. The forecast was a negative 0.5, so better than forecast. But again, anything in the negative is not a positive sign there. All right. Well, that's all the economic data that came out this week. I got 3 fairly brief articles. They're not too long. The first one up is just today's recap of the market. S&P 500 set to snap 4-week win streak as consumer stocks slide. The S&P 500 is set to snap a 4-week win streak Friday as investors pause their bullish bets on stocks amid fears that the Federal Reserve Chairman Jerome Powell could push back against the idea of a dovish pivot at his Jackson Hole speech next week. Again, I don't know why everyone's in such a hurry to start lowering interest rates. I mean, they're not even that high at this point. It's not like it's really creating a strangulation of the economy. Yeah, it has hurt the the mortgage business and the housing market a little bit, but in the end, I mean, the rates that we've had the last couple of years have just been obscenely low. Consumer stocks led the move lower, pressured by weakness in travel and leisure-related stocks. Carnival Corporation, Royal Caribbean, Caesars Entertainment, and Expedia were the biggest laggards in the sector. Other growth sectors of the market, such as tech, were hurt by a fresh climb in Treasury yields as investors mulled the latest comments from Fed members that signal the prospect of Powell striking a hawkish tone at the Jackson Hole Symposium next week. It must be nice to go out to Jackson Hole on the government's dime. Meta platforms fell more than 3%, followed by Google parent Alphabet and Amazon. Chip stocks fell nearly 3% to give up the bulk of their gains from a day earlier as Applied Materials fell despite reporting better than expected quarterly results. St. Louis's James Bullard on Thursday, he's a Fed governor in St. Louis, on Thursday backed the idea of another 75 basis point rate hike that would take the Fed funds rate to a level that will put significant downward pressure on inflation. Again, I don't know if another 75 basis points is going to do a whole hell of a lot. Kansas City Fed President Esther George, however, appeared cautious on larger hikes, saying the central bank has to be, quote, very mindful of the lagged impact of its policy decision on the economy. Well, I wish they thought about that before they printed $5 trillion. That would have been, probably could have avoided most of these issues today. The Fed speak came just days after the release of the Fed's July meeting minutes, quote, revealed a firm commitment from the Fed to remain on an aggressive path of policy tightening, Morgan Stanley said. On the earnings front, Foot Locker rallied 20% after the sports retailer reported quarterly results that topped analyst expectations and announced that former Ulta Beauty CEO Mary Dillon had replaced Richard Johnson as chief executive, or will replace Richard Johnson as chief executive on September 1st. Crypto-related stocks, meanwhile, were dragged lower by a slip in Bitcoin. Coinbase, Riot Blockchain, and MicroStrategy were down heavily. In other news, Bed Bath & Beyond fell 41% after a corporate filing showed that the activist investor Ryan Cohen had sold his entire position in the company. Sentiment on the stock was soured further on worries about the company's balance sheet after housewares retailer reportedly tapped a law firm to explore options to address its debt load. Yep. Not good. If you follow Wall Street Bets on Reddit, I've seen a lot of people lose their butts trying to induce some sort of a short squeeze or some other market manipulation, and it has not worked out real well for them. I mean, some people made a killing on the run up, but if they held on to it or if they bought at the peak, sorry. All right. Next up, a survey finds 50% of companies want to cut their headcount. And this is comes from Yahoo Finance, written by Miles Udland. The U.S. economy has created more than 3 million jobs this year. The number of people working as of July exceeded the total seen in February of 2020, just before the pandemic tipped the economy into recession. And following this hiring binge, companies are now planning to cut back. A new survey from consultancy PricewaterhouseCoopers released this month showed 50% of companies are planning to reduce overall headcount. Additionally, 46% of companies said they are dropping or reducing signing bonuses, while 44% are rescinding offers. Reducing overall headcount doesn't mean all of the respondents of PricewaterhouseCoopers survey are planning layoffs, but at least indicate plans similar to what we've seen in the tech industry, where backfills are paused or previously allocated heads are cut from a department's budget. As the report says, quote, respondents are also taking proactive steps to streamline the workforce and establish the appropriate mix of worker skills for the future. This comes as no surprise. After a frenzy of hiring and a tight labor market over the past few years, executives see the distinction between having people and having people with the right skills, end quote. And this chart shows here the different downturns in the economy and what happened with the labor market. Certainly the worst of it was 2020, where our idiot governments decided to demand we close everything down. Even the worst of it back here in 2008 didn't get any worse than a little over 6%. 2001 looks like it only hit about 2%. And let's see, 1981 looks like it got down to about 3%. Anyways. And what a frenzy it's been since the labor market bottomed in April of 2020. More than 22 million jobs have been added, or in many cases, just added back to the U.S. economy. At 3.5%, the current unemployment rate also matches pre-pandemic lows. As Federal Reserve Chair Jerome Powell said to reporters last month, the U.S. labor market is, quote, very hot. And those comments come before the July jobs report that showed 528,000 jobs were created last month. This recovery, however, has been far from evenly spread across industries, as highlighted by Mark Goldwyn at the Committee for a Responsible Federal Budget earlier this month. Overall, leisure and hospitality employment is still down over 1 million jobs from February of 2020. Meanwhile, industries like professional and business services, which covers a whole host of white-collar, Zoom-based, hybrid remote type jobs, are up almost 1 million jobs, 986,000 to be exact, from pre-pandemic levels. This uneven industry-level recovery is why it sometimes feels like everyone has gotten a new job in the last year, while no restaurant, it seems, is staffed or fully staffed these days. In exchange for a robust and rapid labor recovery, it seems many corporate leaders have been left dissatisfied with resulting changes in their workforce. Last month, Powell said, as the Fed raises rates to tamp down inflation, there will likely be, quote, some softening in the labor market conditions, end quote. It appears managers are hearing the message. And you can see here, this chart shows that the business professionals is up almost 1 million, about 745,000 for the transportation and warehousing. And then the worst of them on the downside are government, down almost 600,000. Yay, less government parasites. I like that. And leisure and hospitality is down 1 million too. So, all right. So that's that article. And last one I got here has to do with the lending industry. Private mortgage lenders bust begins as loan applications crash. This comes from our friends at Zero Hedge. The U.S. mortgage industry could be on the cusp of a bust cycle, as the Federal Reserve's most aggressive interest rate hikes in decades have sent mortgage loan application volume crashing. The 30-year fixed mortgage rate jumped from 3.27 at the start of the year to as high as 6% in mid-June, sparking what we've been warning readers about is an affordability crisis where demand for homes is or has evaporated. So let's see here. Oh, this is the interest rate right here on this chart. Plunging demand for homes can be seen in the pace of mortgage application volumes falling to levels not seen since the lows of the dot-com bubble implosion back in 2000. That's what this chart shows right here. Which means that the rate shock has abruptly curbed the pipeline of new loans and refinancings for mortgage companies, where the poorly capitalized ones will fail first. Bloomberg noted that there would be, quote, no systemic meltdown, end quote, as banks have much less reduced exposure to mortgages post GFC. I assume that's the global financial crisis. However, that doesn't mean there won't be fireworks as private lenders begin to lay off workers and in some cases fail. The, quote, non-banks or independent lenders are poorly capitalized, said Nancy Wallace, chair of the real estate group Berkeley Haas, the business school at the University of California, Berkeley. She said when mortgage applications, quote, tank, many of these lenders will be in, quote, trouble. At least this time, there are more non-bank lenders in the mortgage industry than pre-global financial crisis. Lending patterns said 2/3 of the top 20 lenders were non-bank, compared with about a third in 2004. Inside Mortgage Finance said banks have reduced their market share from about half in 2016 to a third today. The epicenter of the implosion will be independent bankers, such as First Guarantee, who recently filed for bankruptcy after it held onto loans it made that quickly dropped in value earlier this year while trying to package them up to sell to investors. Court papers revealed lending volume dropped when mortgage rates spiked earlier this year. The company said it could no longer bundle new loans as its pipeline dried up. First Guarantee owns Flagstar Bank and Customers Bank, approximately 400. I'm sorry, let me start over. First Guarantee owes Flagstar Bank and Customers Bank approximately $418 million. It also cut hundreds of employees. Another independent lender, Loan Depot, laid off 4,800 jobs in July as its pipeline of mortgages volume dried up. Loan Depot CEO Frank Martell released a statement in July, quote, "After 2 years of record-breaking volumes, the market has contracted sharply and abruptly in 2022. We are taking decisive action to meet this challenge head on," end quote. Loan Depot's equity has crashed more than 75% since going public in February of 2021. The question remains if the lender will follow the path of First Guarantee. Long Island-based Sprout Mortgage is another private lender that fired its employees last month and announced it was closing up shop. Many private lenders can no longer find enough new loans to bundle or get new credit lines to continue operating. And unlike banks, these shops have very limited mobility when it comes to tapping emergency financing lines. Quote, "Part of the reason these companies are distressed is because the loans can't go to the GSEs for funding. The options for funding are more limited, which is especially painful when financial conditions are tightening," said David Goodson, head of securitized credit at Voya Investment Management. Lenders usually try to make loans worth 102 cents on the dollar to cover upfront costs, though some are taking substantial losses and can't sell them for around 85 cents. It appears the Fed-induced rate shock is the culprit behind the implosion of private lenders. We assume more failures are ahead. So, again, that's some not good news of what's going on in the economy. But again, I think things will stabilize at some point in the future. Whether or not that's going to bring those companies back, that remains to be seen. But there are definitely some warts on this pig. And, I don't think any amount of lipstick you put on it is really going to make things better in the short run. So we've got to pay our dues. And like I've said many times before, if you've seen The Shawshank Redemption, we're going to have to crawl through that river of poop to get out the other side. And hopefully the freedom on the other side of that drain pipe is much better than what we're dealing with today. So, all right. Well, that's everything I had for today. I hope everyone has a fantastical weekend. The Astros had a great game yesterday. After I signed off, I think they scored another 10 runs and really put it to the White Sox. But where was that offense on Monday and Tuesday? That would have been, Monday. No, was that right? Yeah, Monday and Tuesday. Because, they gave up both those games. They had the lead most of the game and gave it up late. And but it is nice that they split the series. They're headed off to Atlanta tonight. They'll be playing, I guess, 5:20 Mountain Time. So adjust your calendars accordingly. So let's hope they have another good series in Hotlanta and beat up on the terrible Braves, which beat us in the World Series last fall. But not that I'm bitter. Anyways. All right. Well, like I said, hope everybody has a fantastical weekend. Go out, get some sun, have some fun. And I'll be back on Monday with the weekly economic update with what's on the horizon for next week and any other news that occurred over the weekend. So y'all have a good weekend, and I'll talk to you then. Bye.